the one and only Josh Brown, filling in for him today. So Josh, thank you very much for joining me again on Prof G Markets, our very first show back. Very excited to have you on.
I'm so excited to be here. I wish I were on vacation, but since I'm not, this is the next best thing.
Did you take any vacation this summer? I think I saw some stories of you jet skiing around. I don't know where you were. Were you on vacation?
That's all day, every day. I'm from the South Shore of Long Island. We're born on a jet ski. But I went to I did Lake Como and Milan earlier this summer. It was pretty cool.
Oh, amazing. What were the highlights from Lake Como?
You know what? The lake itself is the only highlight that you need. The hotels are fabulous, obviously. Gran Tremezzo and Pasalacqua are two of the most beautiful hotels I've ever seen. But like, you literally jump in the lake and it's crystal clear. It's a mountain lake and it's pristine and it's worth the trip.
All right. Well, I'm glad you got your rest. Let's get into this episode. Today, we're discussing the latest tech sell-off, and we're also discussing why private funds are entering 401ks or might be entering 401ks. So let's get started. AI may be hitting its first real wall. An MIT study released last week found that, quote, 95% of organizations are getting zero return on their generative AI investments. Adding to the unease, OpenAI CEO Sam Altman recently warned in an interview that we may already be in bubble territory. Meanwhile, Meta just announced a restructuring of its AI division with potential downsizing ahead. These reports fueled fear in the market and triggered a sell-off in US tech, sending every mega-cap stock on a multi-day decline. The Nasdaq fell more than 3%, and the S&P 500 shed $1 trillion in value. So a pretty significant sell-off here. We've had three main drivers for the sell-off, three main catalysts. First were Sam Altman's comments, where in this interview with The Verge, he said, quote, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes," end quote. That was really what got investors spooked. Second, we had this Meta news. It was a New York Times article about Meta. According to the New York Times, Meta is considering downsizing its AI division. And then third was this MIT study, this report from a research group at MIT called NANDA, this AI research group. And their report found, as I said, that 95% of organizations are getting zero return from their investments in generative AI. So those three stories were really what set this off. That's what caused this sell-off. Josh, let's just start with your reactions to the sell-off that we saw in tech last week.
So these things do tend to happen in threes. So I like hearing you run down that list of no, I'm not even joking. So one of my formative experiences 25 years ago was being a young retail stockbroker, trading all of the stocks related to the original dot-com boom. And there were literally three events that happened all within close proximity to each other that I don't want to say caused the top to be formed and then the subsequent 85% crash in the NASDAQ, but they were like the most notable events that happened at the top. So we can argue causation, correlation, but like those specific moments, because there's an echo here to what you just laid out. The first is MicroStrategy, the original MicroStrategy, not the Bitcoin treasury we know today. Same company, same CEO, had an accounting problem. They disclosed it, and it was like a $400 stock that fell 300 points. It was like shocking to the investor class because they were trading 50 different stocks like MicroStrategy. I think at that time it was a quote unquote B2B internet software provider. The professor would probably remember more of the details, but that was notable. Within that same week or two period, this is March of 2000, Bill Gates came out and said he wouldn't buy his own stock. Microsoft. He was still the CEO at the time, and he was talking about how expensive valuations for tech stocks were, and he included his own company. Of course, nobody wanted to hear that. So you had like these like touchstone events, and you can't really point to one of them and say that was the moment. Right. But in hindsight, you can go back and you could be like, "Ooh, that we should have." Known. Okay. So the things that you laid out to me don't spell a death knell for the AI theme. My personal belief is we could run into the end of the decade at least with all the momentum and the money that's been being spent, et cetera. But I think the past couple of days stock price action in the market tells investors how overowned this theme is and how easy it is to now spook the herd. It doesn't take much. Like a rumor of Facebook Meta restructuring the way it's doing its AI hiring is like enough to knock billions of dollars off all these semiconductor stocks and hyperscaler stocks. So I think we're like in kind of a fragile state now, and I think it's okay. Like stocks are supposed to be volatile. So the way I'm thinking about this is right now, if you're an investor or you're a money manager, you should not be out there hunting for your 21st AI stock. Like the 20 you have is probably good. And the last thing I want to say on this, if you think AI is going to be transformative for society, and if you are hugely bullish on the theme, and I know most people are, and with good reason, with your next thought, you should consider the fact that everybody else agrees with you already.
Yeah.
Right? There are currently 20 AI-specific ETFs publicly traded. 20. They all own the same stocks. They all own NVIDIA. They all own Microsoft. So 20 specific ETFs, and all of them have been raising money this summer. 20. And there are another 10 that are considered AI infrastructure. So like they also own utilities and power transmission lines, plus NVIDIA. So you got 30 ETFs that investors are using to capitalize on the AI theme. You got NVIDIA sitting with a $4 trillion market cap. Broadcom is one of the biggest stocks. That's like the stock that people buy because they missed NVIDIA.
Exactly.
AMD is hundreds of billions of market cap. So like you are not, by professing your bullishness for AI, you're not saying anything that anyone doesn't already know.
Yeah. I'm glad you said that about these headlines. I see these headlines, and it seems like a giant nothing burger to me. I mean, let's just look at Sam Altman's full comment. So he said, quote, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes." And that's the part that I quoted, and that's the part that the street's worried about. He then directly followed that up. He said, "Is AI the most important thing to happen in a very long time? My opinion is also yes." So, he's just making a rhetorical point in an interview. To me, it doesn't say anything about his long-term thesis on AI. He also spoke, people are saying in the headlines, I saw this headline on CNBC where it's like, Sam Altman sees a bubble in AI. But he spoke very, very generally about bubbles. He spoke very generally about the idea that, bubbles happen and people get overexcited and, stocks can get ahead of their skis. It's very general stuff. So to me, that I'm like, okay, whatever. Then you have the meta news. And let me just read you the full quote from the New York Times article. It said, quote, "Meta is also looking at downsizing the AI division overall, which could include eliminating roles or moving employees to other parts of the company because it has grown to thousands of people in recent years," the people said. "Discussions remain fluid and no final decisions have been made on the downsizing." So that's what they said about Meta. Again, very soft news. And then this MIT report. I do not understand this. I don't understand, since when did a small group of researchers at MIT putting together a little research project, possibly by undergrads, I actually don't even know. Since when did they become the leading authority on the adoption of generative AI? I mean, these are the kinds of numbers I see in consulting and research reports all the time. These kind of broad numbers. 95% of organizations, they're not seeing a return. Like I've probably seen that like a million times on the internet. And then I sort of think, okay, so MIT says that, fair enough. But isn't this exactly the kind of thing that investors on Wall Street are supposed to be tracking themselves? I mean, isn't it literally the job of the buy-side analyst to look at the companies that he or she is covering and figure out, okay, this is the return that they're getting on their Gen AI investments? I mean, this is what we're all supposed to be focusing on. And then suddenly MIT comes out and says this little research number. a few media outlets pick it up because, let's be honest, it's a fun story. And then suddenly we see this drawdown in the Nasdaq. We see the S&P lose $1 trillion in value. And I just think it's fascinating that this is what brought down the markets. And I agree with your point where it's like, this indicates that there's a level of sensitivity in the markets right now, which is interesting. But I think back to a month, 2 months ago, it wasn't a missile strike on Iran that brought down the markets. It wasn't the president firing the chief of the BLS for supposedly falsifying national economic data. It wasn't even the reintroduction of tariffs. I mean, we saw some small corrections, but the level of correction that we're seeing in tech itself, it didn't really compare to this. I don't understand that. How is it that it was this little obscure research report from a little division out of MIT? How is it that spooked the markets?
I think it's because all of the gains in the market this year have come from the AI infrastructure theme. There's no other show in town.
Yeah.
Even the GLP-1 stocks have been falling. Like nothing else is working. So then people say, all right, well, what are the top performing sectors this year? Utilities, tech, communication services, and financial. I think financial's neck and neck for the third spot. All of those are directly related to earnings growth that's coming from the AI infrastructure build out. The utilities is obvious. I don't need to explain it. These stocks have just undergone a once in a century re-rating. They're all at 52-week highs. They all look unbelievable. And the story that they're telling investors is that they are submitting formal proposals to their regulators for a rate increase. And the justification for the rate increase is the fact that they need to spend money, CapEx, in order to keep pace with the demand coming from the hyperscalers for more electrification needed to facilitate the ubiquitous use of AI. There's one particular utility called Dominion, which I wrote about recently for CNBC. Dominion is like this 100-year-old company, sleepy, boring utility, right? And it just so happens they're based in a place called Loudoun County, which is the cloud data capital of the world. It's in Virginia. And the reason it's there is because a million years ago, AOL was based outside of DC. And that's where like the first, they weren't calling them data centers back then. This predates even cloud computing, but like that's where the first cluster of this stuff started to be built. And then Yahoo came, and then Google came. Now Amazon has spent $50 billion there. So like this is an example of a utility that is completely transforming itself because of demand coming from hyperscaler AI infrastructure. And that's why the utilities are leading the market. Why tech is working, that's obvious. Why communication services is working, that's obvious. Keep in mind, Meta is in that sector. Alphabet's in that sector. Why financials? Why are financials so good? Because Wall Street came alive this year. We have IPOs, CoreWeave, Figma, Bullish, believe it or not, Circle. Like all of a sudden, the amount of activity, private equity, private credit, underwriting, M&A is back. There are deals again. Like that's why the financials are. But all of this is coming as a result of the AI build out and then the ripple effect coming. So you ask the question, like, I don't understand. We're shooting at Iran and nobody cares, but an MIT study and a Facebook rumor surface that could be negative for the AI theme, and the Nasdaq loses $1 trillion in value. That's why. It's the whole thing. There's nothing else going on. GDP growth is sluggish. No offense to anyone who believes otherwise or they think the data is fake. The labor market is okay, but not as good as it was last year, right? Wage growth is gone. So now you have price growth. You have inflation, but no wage growth. Not a great recipe. That's probably why we're going to put a communist in the mayor's office in New York. Like, what other stories are out there? What else is happening in the economy? And the answer is nothing. It's the high-end consumer who owns stocks out there spending with abandon. The reason they're able to do so is because their portfolios are absolutely juiced by record insane amounts of CapEx being spent on AI. And if you pull that leg of the stool away, there's no way we would have had a 30% recovery off the Liberation Day lows in
Yeah.
April. No chance.
Yeah.
Not a chance. If you don't have that leg of the stool, there aren't two other legs. And that's what the market is very precariously balancing itself upon.
Well, I think that really sums it up. And I think that
I'm
is
very good at
possibly
this.
what I think that is probably what is most concerning is it does emphasize the extent to which the entire market is dependent and reliant upon this AI story. And so, yeah, an MIT report comes out and suddenly people get very nervous. I mean, by the way, I'm almost shocked by the lack of conviction that investors seem to have. The fact that this report comes out and then they say, oh, no, our thesis is wrong. That to me is a little bit crazy.
Well, in fairness, we're talking about a 2% move, but the NASDAQ has like tripled
Yes.
in recent years. It's not.
They haven't reversed their opinions, but there has certainly been a vibe shift in AI in the last 2 or 3 days.
I agree.
We're seeing it in the markets. We're also seeing it online, chatter, people saying, oh, is the AI story, is it not going to happen?
The Sam Altman thing is notable, but I think people don't understand what he's saying. He's not saying there's a bubble in AI. He's saying there's a bubble in other people investing in things that might compete with him.
Yes.
He's still going to raise money in the private market at a $500 billion market cap. You know he is. He'll break every record on the books for a privately held company that only 2 years ago was like a not-for-profit. He's going to raise money at a $500 billion valuation. So what he's basically saying is he sees a lot of other people funding things that could represent a challenge to ChatGPT and other products at OpenAI, and they're destined to fail. And that's read between the lines. That what he's basically saying is we own this. And all these other valuations people are paying for other startups are going to look foolish.
Right.
He's not going to say it the way I'm saying it, but that's what he means.
Yeah. No, I think that's definitely right. But just going back to what you say there about the reliance, the dependence in the markets on AI, just some data here. So the top 10 stocks in the S&P right now account for 40% of the entire market cap of the S&P, 25% of the entire earnings of the S&P. NVIDIA alone makes up 8% of the S&P. It's the largest single stock concentration in over 40 years. We've seen this just unbelievable CapEx spending, leading AI companies spending a 10x increase in CapEx in the past 3 years. This is basically the AI market. This is the entire stock market. This is all that anyone cares about. As a money manager yourself, I mean, how are you supposed to kind of defend against that? You can't just get off of the AI train. There's clearly a bunch of AI hype that's happening, and that's sort of what Sam Altman is alluding to a little bit. But how are you supposed to sort of protect yourself and keep those two things in your head at the same time? One, yeah, of course we got to invest in AI. AI is the next thing. Two, at the same time, what does it mean that this MIT report is shaking investors' confidence, at least a little bit?
I think Palantir is a really powerful example of the case that we make with our clients. And just to back up, we're not bears on AI. And, we've been invested in this theme the entire way up. Obviously, these are some of the biggest stocks in the world. I've been bullish and talking about NVIDIA, long NVIDIA personally, for 11 years now. So, I don't want to give people the impression that I'm predicting a crash. But we're very sober when we talk to clients about the possibility that there could be a hiccup along the way or something worse. And, we preach diversification, which seems really quaint right now, but like fanny packs, it will come back into style eventually. It always does. It could be many, many years between now and when that happens. We're managing $6.5 billion for over 4,000 families. And people have a lot of money at risk in the stock market with good reason. People are going to have very long lifespans and they need to earn above inflation returns. And our job is to help people, get from A to Z. And Z could be a long way off. So we have to take risk. We have no choice. But we want to take intelligent risks. I was talking to a client yesterday. extraordinarily wealthy person, very successful, way more successful than I am. But one of the things that we're talking about, he's saying, look, I understand, diversify, et cetera, but it seems like none of these other stocks matter anymore. And he had a really good point. I remember a time where like Target would report earnings, the markets would almost shut down because everybody would want to hear what the CEO had to say about the outlook and the consumer. And but no one even notices anymore. There were times where like McDonald's and Home Depot and like these were like bellwether, like what is the state of the consumer? Let's tune in and listen. These earnings reports in the last week, they come and go because they're not the thing that's driving earnings. When you talk about the size of the hyperscalers in the S&P 500, like what percent they make up, proportionally, the earnings growth is even bigger. The earnings growth is coming from a very select group of stocks. They happen to be so gigantic that it's meaningful for the overall index. And then you start talking about like, oh, Freeport-McMoRan is a bellwether for copper demand, and nobody gives a shit. I don't even think its market cap is $20 billion. So like, it almost doesn't matter. The amount that Nvidia's market cap moves in a day is larger than 400 companies in the S&P 500. So when people say like, oh, the try to connect the dots, the stock market, the economy, from my perspective, they've never been further apart. So I don't think the Main Street economy is bad. I just don't think it looks anything like what the S&P has done over the last couple of years, and that people struggle with that disconnect. So our message, to get to the answer to your question in a very roundabout way, but our message, Ed, is the market that we're in right now is not the market that we're always going to be in. This year, the factor with the most import to returns is momentum. Fine, we all understand that, but that's not every year. Some years it's dividend yield. Some years it's balance sheet quality. Some years it's competitive moat. Some years it's value. Some years it's a size factor, and small cap does better than large cap. It's been a minute, but it happens. The purpose of maintaining diversification is you always have to say you're sorry, but you also never have to say you're sorry. You are not going to be able to race Nvidia and Broadcom with a portfolio year after year and not eventually pay the penalty. So I mentioned Palantir. This company put up one of the most insanely good earnings reports I have ever seen. I'm doing this 28 years. Insane on every metric. The rate at which they're adding corporate customers, the rate at which they're adding government contracts, the growth of cash flow, the growth of profit, the growth of profit margin. You look at this report, and then the CEO comes on the call, and he's like, fuck you to the haters. Literally, that's what he did. The stock has now erased the entirety of its post-earnings pop. It had this massive move where like...
It's down like 10%, right? Something crazy.
So like every growth manager who owned stocks and didn't own Palantir basically had to buy it that day or get fired, right? And then like within a week, that entire post-earnings pop disappears. What is the message? The message is, we already know how good AI is. We already get it. We already know how good Palantir is. That's why it's a $400 billion market cap on revenue of $4 billion. We get it. Everybody gets it. There's no one left to figure it out. So that's really what we're trying to get across to clients. It's not saying we're bearish on AI. It's just like, dude, how much more do you think could possibly be in the tank, given that everyone agrees?
Yeah. But I think some people would say that sounds like a little bit like a bubble.
It is a bubble, but it could be, but it could be 1997. It doesn't have to be March of 2000 yet. Of course, it's a bubble. There's a CapEx bubble every generation. It's not that rare. It's not that unique. We had them in the 50s. We had them in the 60s, in the 70s. But it always happens. It's happening again. No big deal. It's not a signal to sell everything and hide. Not every CapEx bubble has to result in a generational crash. You could just have a bear market follow this. And what if it starts 3 years from now? Think of all the money that you are missing out on making worrying about it's a bubble, it's not a bubble.
The answer remaining that the diversification is key, I assume, is basically where you ultimately land. But again, it's an interesting thing because a lot of people, as you say these days, is saying, well, diversification's for losers. You might as well be in the S&P 10.
I have some clients where if I listen to them, their portfolio would be like 30% NVIDIA, 30% Palantir.
They'd be crushing it.
And by the way, they would have won big. The problem is, what does that look when this ends? What does that look like? And I want to say one thing about the bubble idea, and then we can move on. The 2000 bubble burst. It's really important. I was talking to a venture capitalist who is about my age. We both had roughly the same experience when we started in the 90s. There was about I don't know, let's call it 450 billion in market cap in the stocks that we tend to identify with the 2000 bubble. Like, it was not large at all. 450 billion in market cap. The combined profits of all of those companies was like 15 billion. It was tiny, like literally tiny. OpenAI is going to do like $15 billion in profit this year alone by itself. And when you look at the revenue of the companies involved today and the market cap and the amount of employees and the amount of customers, it's literally night and day. Back then, forget about price to earnings ratio. These were companies that were pre-revenue. No revenue, no business model. You can't say that today. These companies are among the most successful companies of all time on every metric. Tons of revenue, tons of earnings, tons of growth. So it's not a great analog. Back then, there were 200 million internet users. There are 7 billion internet users right now. It's a completely different world. So I don't love the comparison.
Investments that they are typically locked out of. So this executive order actually happened a couple of weeks ago. I've been on vacation, so that's why we haven't really covered it, but it is important. It essentially means that your 401k manager, so, for us, it's a manager called Empower.
So that's a 401k administrator. So you have the plan sponsor, which is the company that you work for.
Yes, please.
And then you've got the administrator, which is effectively like the platform that you log into to make your investments.
Yes. And those platforms can now offer alternative investments. So private equity, private credit, even digital assets like crypto. And there are $9 trillion in retirement accounts in America today, and 90 million Americans have some form of retirement account. So this is a big deal for private market investment. It's basically opening it up to $9 trillion in capital. And so I think this is relevant for a lot of reasons, one of which is we've been talking a lot on this show about this idea that retail investors are increasingly locked out of investment opportunities that are reserved for private investors, institutional investors, accredited investors. We've talked about that as well. And, I've talked about the idea that you've got OpenAI, which is being valued at $500 billion, most valuable private company in history. And yet, if you're a regular investor, if you're a retail investor, you can't get in. So that's kind of another talk track, but it's certainly related. It's also relevant because you wrote an article about this new executive order on your blog page, Downtown Josh Brown. So, Josh, give us your reactions to the executive order. A lot of people are saying this is going to open up the opportunities for retail investors. Now they can get into alternative assets. And there are other people saying, no, this is going to sort of expose retail investors to all of the risk and the craziness that exists in the private investment world. Plus, Trump was being lobbied by all of these private investment groups.
Yeah. All right. I think it's a really big deal for the private equity and private credit industry. I think it's a nothing burger for investors. There's no danger here. The danger is like lagging returns, because you're going to take a portion of your 401k, you're going to allocate it into some high fee private equity fund. You're going to lock up that portion of your money, which is already locked up anyway. You're sitting with a 401k for decades anyway, so that's not a big deal. So you're giving up liquidity, but who cares, because it's not liquid for you anyway. All right, so I could see that people saying that's a negative. I don't really view it that way. I think the longer you hold investments, the better, personally. So I don't know that that's definitely a negative in a 401k. All right, so put that hysteria aside. The other thing people will say is like, "Oh, you're exposing people to new. You're at risk anyway." When you cite Nvidia is 8% of the S&P 5, well, what do you think America owns in their 401k? They're already at great risk. They already are overloaded in gigantic technology stocks in the midst of a capex bubble. So it's not like oh, now all of a sudden they're at risk. Stocks are risky. They're inherently risky. Here's a fun fact. I don't mean to name drop. I was talking with a legendary investor, Peter Lynch, considered to be the GOAT.
Wow.
Literally
Name drop.
I was talking.
Love it.
Fine, whatever. I'm owning it.
You own it. Exactly. You own it.
I'm dropping that name. I'm picking it back up. I'll drop it again. Peter Lynch asked me a question. He stumped me. He said, "Do you know what the average range of a New York Stock Exchange stock is over the course of a year?" And I was like, "The average range, like how much from the high to the low?" And I said like 30%. He goes, "Okay, 90% of people say 30%. It's 100." He said, "Josh, it's 100%."
What?
And I said, "What do you mean?" He said, "Well, just think about it. A stock starts the year at 20, drops to 14, rallies to 28. That's 100% range.
Yeah.
It's not linear. It doesn't like go in the it doesn't go all in one direction. The average stock doesn't double or get cut in half."
Yeah.
So like he's like, people don't even understand the basics of how volatile the stock market is. So I bring that up to you so I could drop a name. No, I bring that up to you, Ed, because
what does that
stocks
have to do with anything, huh?
Public stocks are volatile.
Yes.
So private equity, which is just privately owned companies, that volatility is not like this new dimension of risk. Okay, so the hysteria around this is not necessarily founded. The last thing is actually really important.
Yeah.
For the people listening to this, everyone pay attention to me. I hope you already have been. This is really important. You're not forced to do anything. No one's gonna like shove private equity down your throat. They might include it as a sleeve in a target date or a life cycle fund, but it's going to be tiny. You won't even know it's there, and you can opt out of it if you don't want it. You could say, "Well, I'm not buying that life cycle fund because it has private equity, and I read something about the high fees of private equity funds, and I don't believe in it, and I'm opting out."
Yeah, but those are the listeners of this show.
Choice.
Those are the people who kind of know what they're doing. I mean, certainly going to be a lot of people who don't really know what any of this means. But the administrator is going to say, "Oh, you got to get into this. This is the greatest thing since sliced bread."
All right. So yeah, you won't hear that from an administrator because none of them want to get sued. And that's one of the interesting things I wrote about.
Fair enough.
I agree with you, Ed. That's not a good thing. If plan sponsors start pounding the table to their employees why they should allocate to private equity, that's problematic, but there's no incentive for them to do that. So it's not, I don't think it's a real danger. What's actually going to happen is these will be very large providers like Blackstone and Vanguard and huge private equity firms, and they'll create specific vehicles meant precisely for this 401k use case. So you are not going to be investing alongside people that traditionally invest in private equity. They're going to create like a kiddie pool for you. I'm not saying it's going to be bad. I'm just saying don't think you're investing with Mark Cuban. You will 100% are not. Those people are getting into the top funds. That is not going to be available through Vanguard and Fidelity. You can't. Why would they? If you're an amazing private equity investor, why would you be looking to take in retail flows? It makes no sense. Nobody would do it. So I don't think this is that big of a deal, and I don't think that many people are going to be into it. The crypto stuff will probably attract an audience faster. Young workers who see an option to put 10% of their 401k into a Bitcoin fund, they're going to do it. 100% they're going to do it. The venture thing is really where we get silly. So you kind of interchangeably were talking about OpenAI and private equity. To be very clear, like venture capital opportunities do not belong in a 401k. Just it's like the ultimate asset class mismatch. There's absolutely no reason for there to be shares of privately held experimental companies with no earnings and revenue. The odds of that working at scale are zero. The nature of venture capital is like 1 out of 50 companies turns into something, and 1 out of 100 can outperform regular stock market. It's like very, very difficult odds. It's a very specialized market where the practitioners know what they're doing. You can't export that into a mutual fund wrapper and throw it into, an insurance company's 401k. So I don't like that at all. I don't think it's necessary. So in summation, you will see private credit be substituted for some public bonds. You will see private equity be substituted for some of the equity portion. It'll be minor. Very few people will actually be interested. I don't think anyone's going to be massively hurt by it. Venture capital in a 401k is fucking stupid. And Bitcoin is probably going to attain some real fund flows, just given how much young people are attracted to being invested in crypto.
I find it interesting that venture capital is sort of off the table. It's too silly in your view, but Bitcoin you don't seem to have, or crypto you don't seem to have the same view.
I'm not endorsing people do this, but I think it's just an easier rollout into a product at a 401k than venture capital would be. Mm-hmm. So you could have an existing mutual fund, and some of the large asset managers do this, where they have a sleeve in their portfolio for pre-public, pre-IPO venture-backed startup. I'm okay with that. But like, you can't invest into Andreessen Horowitz in a 401k because they're not going to give you the access to be able to do so. So like, you're not going to get the best of the best. And in venture capital, you have to be in the best funds. You can't be the 4th best fund. There's just no way. So I think that's like a very winner-take-all type of investing. Bitcoin is a commodity. One Bitcoin's as good as another Bitcoin, and a Bitcoin fund doesn't need a manager.
Yeah.
So that's where I would draw that distinction.
Okay. I'll lay down my views on this. So I think this has been sort of portrayed as, we are democratizing access to alternative investments. That's been the pitch. That really has been the pitch.
I know.
And that's the part that I really find a little annoying. And I think it's especially annoying to me because I've been talking a lot about this, about how the private markets have been getting so big and there's so much money now that they are essentially acting as if they are the public markets. There's basically no incentive to IPO if you're an OpenAI or if you're a Stripe or if you're a Databricks at this point. If you're a big venture-backed company, and as you say, with massive profits, massive revenues, you're well on your way. It used to be that you go public to get some liquidity. You don't really need to do that anymore. The liquidity's there in the private markets, and what it essentially means is that if you want to get in on AI, you only have your NVIDIAs and your big tech stocks to choose from in the public markets. You can't invest in OpenAI and Anthropic and all of these other AI startups that, honestly, that's where the action's kind of happening, at least on the consumer side.
The 401k, though, is not the answer to that problem.
Well, so fair enough. And this is part of my issue here. So the way that this has been presented is that now you have access through your 401k. And by the way, I agree the 401k is not where you should be putting that money. But I also think there should be a distinction here. There's a huge difference between investing in a private fund versus investing in a private company. If you want to go invest in a private company with some leftover money that you have, I think that would be great. And the big difference between those two things is, one is autonomy. I mean, you're kind of just letting these money managers decide what they're going to invest in. And as you say, these venture funds that are going to go in these 401ks are probably going to be ridiculous. And the other big thing is the fees. I mean, you're going to be paying stupid fees for these funds that, as you've pointed out in the past, don't even perform well. I mean, I think one thing that you brought up in your article is that actually the stock returns on the top private equity companies, I love this, the stock has outperformed their own funds.
People hated this. People
It's
hated this so
unbelievable.
much. Let's take Blackstone as an example.
Yeah.
This is one of the best performing stocks in the S&P financial services sector. It actually, when it came public, it wasn't a corporation; it was a partnership, and they changed the structure because a lot of funds couldn't own it as a partnership structure. They have to invest in corporations. So all of these companies, KKR, Blackstone, they did these conversions, and now they're all in the S&P 500. I think Blackstone's up 1,800% since it came public in 2007, and that's including the stock probably losing like 60% of its value during the 2008 crash. So this has been a runaway winner. I can promise you, Blackstone doesn't have a single fund, private credit or equity, that has done as well as its stock price has. At least I'd be shocked. I really don't think so. I know the average fund is not. So what we did, my research partner Sean and I, is we took the universe of the top 10 publicly traded private equity and private credit funds, and you know all the names. It's Ares, it's Apollo, it's Carlyle. These are amazing companies, by the way. But we took the top 10, we market cap weighted it, and then we equal weighted it just to make sure that we weren't being unfair.
Yeah.
We compared it to Bloomberg has a PE index benchmark. And I'm sure people will complain about what's in it. But effectively, it's the best way we know of to track the returns of private equity funds. So basically, we raced the sponsors themselves, like the companies that launched the funds, their publicly traded stock prices versus the products they sell. And the results are hilarious. So if you had invested in the market cap weighted basket of the top 10 private equity companies, invested in their stocks, $100 turned into $264 going back to 2022. If you had put the money into the Bloomberg PE index benchmark, let's just assume that's like an approximate of the average of all their funds, $100 would have turned into $113. So it's like not even like you almost can't even see.
So to put it in percentage terms, the funds returned 4% per year. The stocks returned 38%.
Yes.
Per year.
Now, is it fair? I'm just using the last 3 years. No, and I don't know what the next 3 years will be. Maybe it'll be the opposite. But it struck me, why be a player in the casino when you can own a piece of the casino and let other people try to pick private equity funds to invest in? So I just thought that was an interesting way to think about it.
Yeah, and I think it's indicative of the point, which is I think unanimously understood at this point, which is that these funds, net of fees, are not very good. You compare them to the S&P. The S&P consistently, I don't know if there's really been a 10-year span in the history of the stock market where the S&P has underperformed these PE funds. Maybe in the early days of private equity.
In the early days, if Mitt Romney was your private equity manager at Bain Capital in 1993,
on the Biscayne.
Their returns are amazing. I read Steve Schwartzman's biography last year. It's incredible what these people have done. I'm friendly with Harvey Schwartz at Carlyle. I interviewed him for my podcast.
Boom.
Well, I'm saying I revere these people. I think they're amazing.
The distinction is becoming increasingly blurry. I don't know if you agree with that.
Yeah,
but
it's true. It's true.
I mean, the private markets are functioning pretty much like the public markets. And, I think it's a shame that this is happening, because I think it's a shame that we're not having more companies, more strong, growthy AI companies that have really proven themselves. They're not going public. And I'll just put it flat out. I want to invest in OpenAI. I want to invest in all the AI startups.
Or they are coming public, but once all of the money has already been made.
Exactly.
Coming public at a full valuation.
And that's a shame. And my issue is, I think a lot of people saw this headline. They said, well, this solves the problem. You can get in. It's like, no. I can get in some bullshit basket and pay 1 to 2% in fees per year, and then pay the 20% in the carry.
I was going to say, if there's a venture capital fund that's like actively courting people in their 20s and 30s that are not like centimillionaires, you probably don't really want to invest there. The best way to get in early on a hot venture-backed private company that then goes public is to work there and be paid in part with RSUs or ISOs, some sort of stock option. That's the best way. The second best way is to be like the college roommate of the guy that founds Uber. Like that's a really great way. And I'm saying this like half facetiously, but like at the end of the day, life is not fair. Don't you think everybody wishes that they had the ability to invest in Facebook in 2006? Like obviously everybody, it's not going to be democratized because the wealth of the world is not democratized. It sucks. Get mad about it. Start a band. Put on eyeliner. You know what I mean? Like, what do you want me to tell you? Like, it's not going to be fair. It's never going to be fair. So
it's become increasingly unfair, is what I would say. It's gotten a little out of control.
One thing that's true, Ed, and one reason that's true.
Yeah.
People talk about the small cap premium in the stock market, which has vanished. But there used to be this concept that small caps offered better performance than large caps over time. And there were all these reasons for it, like growing earnings off of a smaller base and the multiple increasing as companies become more well-known. Like there are a lot of that's vanished. And people don't understand why it vanished. The reason is the best young growth companies no longer come public as small caps.
Exactly.
They come public with $20 billion valuations. They go right into the S&P.
This is my point. $500 billion valuations. OpenAI is 19th most valuable company in the world. It's a private company.
And 10 people benefited.
Exactly. And my point to you, Josh, is that's new. That's new. And I do believe it is unfair. And fair point. You know, I'm complaining. Go start a band. Go work for OpenAI if you really want to. Maybe I fucking will. Maybe I'll be their podcaster. But my point is, we, the young people, the retail investors, can't get in. And I just want to say this because it happened while I was on break. There was a Business Insider article that came out about this at this point that I've been making. Specifically about how all the best companies are staying private and kind of the shitty companies, sans maybe Figma, are going public. And so we're frozen out.
I disagree with that. I disagree with that premise. I don't think it's all shitty companies going public, but okay, continue.
Okay. Less impressive companies. Maybe I'm being too harsh.
Well, remains to be seen who's impressive. You need a little bit more seasoning. You need a little bit more time for these companies to see which are the good and which are the bad.
We'll table this one, and then you and I will get into an argument about this later because we do need to get through this. I just want to cover this one point. Joe Weisenthal, podcaster, Bloomberg journalist.
Shout out to Joe. That's my boy.
I like the guy. He came at me on Twitter. He posted this article. He said, the way people talk about wanting to get access to hot private companies drives me crazy, riddled with hindsight bias and other biases. I just want to say, Joe, you got to at me next time. I mean, he screenshotted the article, Ed Elson. And there's people talking about this. It's me talking about it. So he's got to at me next time.
That's a vicious subtweet where he screen grabs your quotes in an article he doesn't like. That's
exactly.
That's a very aggressive.
I don't know why he's coming at me.
You and Joe, if you guys spend time together, you guys actually would probably be friends. Joe is awesome.
I totally agree. But we're going to have to get over this bit.
I'm going to connect you guys behind the scenes after this. I'll do it. I got it.
Okay, thanks, Josh. Let's take a look at the week ahead. We'll see fresh inflation data from the Personal Consumption Expenditures Index for July. We'll also see consumer confidence for August. And NVIDIA is reporting earnings on Wednesday night. Now, we're recording this just before the Jackson Hole summit where Jay Powell will be speaking, but a lot of stuff going on in Fed land, specifically Trump asking one of the Fed governors to resign. We're seeing more pressure on the Federal Reserve. Any thoughts on what's happening with the Fed right now, Josh, and perhaps any predictions maybe on interest rates or what's going to happen in terms of the Fed governorship? What's going on here with the Fed?
On Wall Street, this is being characterized as Powell's last stand, meaning this is conceivably his last Jackson Hole address. if you believe the president's rhetoric on Twitter, this guy's out of here when his term ends in May, if not sooner. So this is really his chance, I think, to cement his legacy rhetorically at the podium. There's a lot of people who think he's going to use this as an opportunity to reassert the need for there to be an independent Fed and to do something that's somewhat politically charged. I actually am predicting I would go the other way. I think this is going to be more of like, I don't want to say victory lap, but like, I think he's going to signal that September we're getting a rate cut because the Fed has given it so long and has done what it had to do. The big debate in the Fed minutes that came out this week, some of the committee believe that the risk is to the upside, meaning higher inflation, stickier inflation. And then some believe the risk is actually to the downside because the labor market, by some metrics, is weakening. So there's not agreement in the committee. It's not like they all think one thing. And you had two dissenters on the Fed's last FOMC where they chose not to cut rates. You had two dissenters who thought they should have. So, and that's, it's not that rare, but it's rare enough that it's worth mentioning.
Yeah.
So I think the Fed is not going to give I think Powell is not going to give a politically charged speech. I think he's going to give us a dovish hint. And then in September, he'll follow through with maybe 25 basis point rate cut. And I actually think he's aiming to cool down the temperature, not, stick his chin up and say, come fuck with me.
Cool down the temperature politically.
Yeah.
I mean, that is what is interesting. Is I agree. I think he does not want to get involved in a political spat. By the way, Scott takes the other side of this. He thinks, he says Powell's not going to cut rates because he wants to sort of give the finger. My view is this guy doesn't have an ego like that.
Yeah, I don't think so. I don't think so.
But what you're saying is he does want to turn down the temperature politically because it has become politicized.
The more independently he tries to act as Fed chair, the more he's endangering.
He doesn't have a choice.
But the more he's endangering the independence of the Fed. This is not the first president in history to have an opinion on where interest rates should be. This is not the first president in history to try to intimidate the chairman of the Federal Reserve into acting on the administration's best interest. It's just not. He has a style all his own. It's the first president to do this on Twitter.
Important detail.
No, I get it. But I don't think that Powell thinks what's in the best interest of the institution is to give the middle finger to Donald Trump.
Agreed.
And I also don't think a rate cut would be so crazy. Rates are too tight for a 1 to 2% GDP growth environment. If you're basing your opinion on whether or not rates should be cut on the stock market, then you don't even understand how the Fed works. The Fed is not supposed to be paying attention to the stock market as its own variable. It's employment versus costs. I don't think we're in an inflationary emergency, and I think rates are too high given economic growth. The labor market is not as strong as it was last year, and they did a rate cut last year. So I don't think it's that hard for Powell to get to the place where he says, all right, here's your fucking 25 basis points. Enough already. And that's what I think. Well, that's my prediction. I don't know anything more than anyone else. That's what I think.
I like that prediction. Okay. Josh Brown is the co-founder and CEO of Ritholtz Wealth Management, a New York City-based investment advisory firm managing $6.5 billion in assets for individuals, corporate retirement plans, and foundations. He also is a podcaster. You should check out his podcast, The Compound and Friends. Am I missing anything, Josh?
No, it's enough. It's enough already with me. It's enough.
Okay. We really appreciate you standing in for Scott this week. Congratulations. Your idea that you actually came on the podcast and discussed, it's now a reality. You founded the nonprofit group Invest America, which was really the force that made this happen. Let's just start with that. How did this all come about? What does this mean for America?
Well, I think it's transformed. First, thanks for having me on, Ed. It's great to be back. And, I know how much, you and Scott, worry about and think about the fact that too many Americans are left out and left behind, not in the game of capitalism. And when I was on before, I said, this will be transformational if we get it done. This is a platform that literally creates universal private ownership from birth, a 401k from birth, that gets every child, 3.7 million kids born a year, gets every one of those kids into the game. Now, think about this, Ed. Under the age of 18, that's 65 million kids. And of those 65 million, 50 million would never own an account that compounds.
Yeah.
And now they will all own an account that compounds, that's aligned with the upside of capitalism. And we know, unless you have a compounding asset in this country, like there's no chance that you can keep up with the cost of living increases, et cetera. And so I think in that regard, it's a game changer. How did it come about? Well, I've been working on this idea to first get it passed into law for 4 years. And we were working with both sides of the aisle. You probably saw the letter out today with Cory Booker and Ted Cruz that went out to 1,000 chief executives asking them all to contribute money into the accounts of our kids. And, I've been working with both of those senators and many other people on Capitol Hill across the political spectrum. And we were prepared. We tried to get this done with Biden. As I explained to you guys, we didn't make a ton of progress there, even though we had a lot of support. And we had an opening with this president. Michael Dell who's a good friend, played a key role in brokering the final relationship. He and I went and saw the president, and the president loved the idea. He made the final call to the speaker that got it included in the reconciliation bill. That occurred in April of this year. Now, fortunately, we already had the beach softened in the House and the Senate. So when the president made the call that he wanted to see it in the reconciliation bill, we had already the draft of the Invest America Act on the Senate side. We dropped in the language. So it's pretty easy from there to get it included. And then, of course, the bill passed, which, let's just stop there for a second. I mean, this is a change to our social contract on the order of magnitude of Social Security itself. The federal government's going to launch the largest consumer project in the history of the federal government, 60 million accounts for every kid under the age of 18. And so I think it was extraordinary that we were able to get that accomplished in the law is a fact to celebrate. But as you know, that was never what this was about. It wasn't just, getting it passed into law. It was then executing it and making sure that we turned it into a platform for change.
Just to put it out there, I think most people know this, but I think it's an incredible idea. I'm really excited about it. Just the idea that, so many people are losing their faith in the system, and a lot of that is because they've been left out of the system. So what are we doing here? We're automatically buying you into the system by investing you in the stock market, in just low-cost index funds, which we should really all be invested in. But I want to play devil's advocate and just throw out criticisms that I've been seeing online. One criticism I've seen is this just makes rich people richer because rich people already own stocks. And so now we're putting more capital into the market, so they're going to get richer. I've also seen people say, oh, if everyone gets an investment account, then that's like no one getting an investment account because you're not actually getting ahead. And then I've also seen another criticism, which is this is billionaires appeasing the president. This is been a big concern with this administration. Michael Dell gives $6 billion and gets in good with Trump. I just want to hear what you would say to those criticisms.
Yeah, let's first start with this idea of, the rich getting richer somehow, because I think this is the biggest fallacy, Ed. Listen, the rich already have a lot of money. Rich kids already have a lot of money. So the fact that they have an account is somewhat irrelevant to those kids, because remember, in this country, we have something called 529 accounts, right? There's 16.1 million 529 accounts. These are accounts for college savings. 15.8 million of those are owned by people in the top 10% of income. Okay, they already have, all their kids already, my kids have these accounts. That's how, in fact, the motivation, the story with my kids, how Invest America started was my older son, Lincoln, said, Dad, this is great that we have an account, but what about all the kids that don't? That was really the inspiration that drove this. So those kids are doing fine. This takes the 50 million kids who would never, not only as children, but never in their lifetime, have an account that compounded with the stock market and getting them into the game from birth. So by definition, they disproportionately benefit because the alternative is zero, Ed. Right? And now these kids, if they start with $1,000 and an employer or mom and dad or a philanthropist adds just $750 a year, that's $50,000 at the age of 18. That's $150,000 at age 30, and it's $1 million at age 50 or 55 using the 75-year track record of the S&P 500. So undisputably, this will disproportionately benefit those who have less. And let's talk about the Dell contribution. A key component of their announcement, Ed, was that their $6.25 billion is only going to families that live in zip codes where the average income is less than $150,000. So they're excluding the highest earning zip codes in the country. And so I think you're going to see a lot of that as people start announcing additions to these programs, the philanthropic contributions, the corporate contributions. I think a lot of those will be income-based. And so that will also help to ameliorate that. Secondly, let's talk about this question of billionaires appeasing the president, right? There's no doubt, right, that I think in all administrations, you have people who are currying favor with administrations, doing things that administrations, might like. And when it comes to this president, certainly he's closer to the business community than Biden was. But I'll tell you, if you look at the people who are, in the White House, it's Democrat and Republican CEOs across the board. Even if you just look at the day that we announced, had the Invest America Roundtable, Dara Khosrowshahi, who's been a critic, I think if you follow his Twitter feed, pretty clear he's on the left of a lot of issues. He was there and he praised this program. Cory Booker and Mark Warner, lots of people on the left. The Clintons have been big supporters of this idea. And so, this is a big bipartisan tent. And so the fact that Michael Dell, who nobody views as a diehard or super conservative, raging Republican, steps forward and says, listen, I'm going to do this because my foundation has been investing in kids. And the number one thing they like about it, Ed, if you want to give away $6 billion, okay, and you have to give it away today, how do you do it? You give it to a charity and then the charity somehow gives it to kids, but how much actually makes it to the kids, Ed? Right? And how do you track what makes it to the kids? And as entrepreneurs, a lot of people want to give away a lot of money, but they want it to be performance-based. They want to know that it makes it to the kids. They don't want some charity apparatus in the middle to take half of it. So for the first time, we have a direct giving platform where these folks can give away billions and billions of dollars at scale. They know it goes directly into the kids' accounts. Nobody's taking a scrape in the middle, and it's going to compound according to the rules that have been promulgated, which means that the kids can't take the money out, right, until they're 18. And then at 18, they can only use it, a part of it, to buy a home, start a business, go to school, or it rolls into the IRA retirement rules. And so now we've set up a platform. I think of it a lot like, iOS, and now these are the applications that are getting built on top of it. We now have a universal operating system for kids. It's universal ownership, private accounts from birth.
Yeah, it certainly seems as though this is perhaps the infrastructure through which the ultra wealthy can start giving away money back and investing it back into America. Michael gave away around 6% of his net worth. I'm waiting for someone to match him. Yeah. I'm waiting for someone like a Zuckerberg to get out there and match him. Do you think that that's going to happen? Are we going to see more mega billionaires or just wealthy people in general contributing to this program?
We know Michael and I are leading the Invest America Giving Council. We're calling everybody who's signed on to the Giving Pledge. These are a lot of our friends, and I can tell you our phones were blowing up yesterday with people who wanted to sponsor states, right? The state of Texas or California or Indiana or Wisconsin or Ohio, to give to all the kids who are born in those states, who wanted to adopt cities, who wanted, to follow Michael's lead. And I see you're going to see major announcements in this regard. And by the way, those were with people, CEOs, entrepreneurs, and billionaires on both sides of the political aisle.
Yeah.
And Michael and Susan were bold and entrepreneurial in going first, right? They were going to take the shrapnel to the extent there was any. And I think now it's made it safe for other wealthy people to follow. But let's not just focus on the ultra wealthy. We have a long tail of extraordinary philanthropy in this country, right? And so there are going to be people who adopt their school, right? It may be, or maybe adopt a grade in their school, say for all the kids in this grade, and they'll work with their school to make sure that they contribute to every one of those accounts. There are going to be churches who raise money to make sure that all the kids of the church get money added to their accounts, right? There are going to be moms and dads that just say all the friends of ours who have kids. I will tell you this, Ed, the number of children that have been born into my life. I did this with all my nieces and nephews when they were born, but it was hard. I had to set up custodial accounts for them, right? This will be the best baby gift or birthday gift or bar mitzvah gift you can possibly give to anybody, right? None of us really have good creative gift ideas. Now we can just give them $1,000 worth of stocks and, let it grow and compound. And so I think, yes, the head end of philanthropy is going to be potent. It's going to be great. I myself am looking at adding to the accounts in the state of Indiana, where I'm born. State of Indiana, there are 87,000 kids born a year. And so I'm talking with the senators, the governor, and others in the state. How can we add money to the states of every kid born in the state of Indiana? The state of Texas just announced today they're going to add $1,000 to every account in the state of Texas, all the kids born in the state of Texas. I'll tell you, I've heard from many states now, governors or aspiring governors who want to add to those accounts. So we're going to set off a little competition in the country. And, God bless, man. This is what this country needs. It's going to unify people. It's going to get people back in the game. There's a reason less than half of people under the age of 40 believe in capitalism, Ed. Right. It doesn't work for them. Exactly. They're left out. They're left behind. They don't own anything. And if you don't own anything, it's hard to get them excited about it. So why not burn the system down and say, let's start with a new system, right? Yes. But you get people into the game. You get them winning with America, and they don't have to win at the same level as everybody else. We're not guaranteeing everybody they're going to be a millionaire, but going from nothing to something.
Yes.
Going from zero and the prospect of zero your whole life to one, that is a far bigger move than going from 1 to 5. I will tell you, this comes from a guy who had zero. I know what it feels like to be on the outside looking in. I know how it felt to go from nothing to something. So that is the promise we're going to make to all of America's kids. We're going to get you from nothing to something. And then it's on you to get out there to hustle to add to the accounts.
100%. My final question before we let you go here. I love the idea. They're called Trump accounts.
Yeah.
Did we have to call them Trump accounts? I mean, if we want, it seems like that's the easiest way to politicize the thing. Yeah. If we want to get everyone on both sides.
Yeah.
Can we call them Dell accounts? Can we call them Brad accounts?
I will say this. When you look at the history in the Senate, we call Roth IRAs Roths after Senator Roth. We call Pell Grants after Senator Pell. There actually is precedence for this. I know for some people it's polarizing, but I will tell you, they would not exist without the efforts of this president. And, Roth IRAs would not exist without the efforts of Senator Roth. And so, for the time being that he's president, they're going to be called Trump accounts, and they may be called Trump accounts forever. But history is ultimately the judge, right? And history will call these what history will call them. But I, for one, think due to his efforts, I look at it, and by the way, I can tell you, he's talked to people on both sides of the aisle. He's out there talking to corporations. He's out there talking to philanthropists. He really believes in this. He said to me, it's the whole meaning of my presidency to get everybody else in the game, right? And so I know there are a lot of things people don't like about President Trump or do like about President Trump. I'm not here to litigate that battle over this piece of legislation. Yeah. The Invest America Act is unequivocally good for this country. It's a uniting feature for this country. It's a big bipartisan intent. And I'm grateful for his leadership in helping make it happen.
Well, I think it's really exciting. And I think it's really exciting that Michael Dell is contributing as much as he's contributing. I really do hope that this continues and creates something of a domino effect. Brad, really good to see you.
Great to see you.
Thank you for joining us.
And I love watching you all the time, man. It's amazing what you and Scott are out there doing. Keep it up. And let's. I'll come back and update you guys as this progresses.
Please
because
do.
I think it's so consistent with the platform and the message you guys are delivering.
100% agree. We really appreciate it. Thank you, Brad.
Great to see you.
So the other day, a friend asked me a question. He said, if Trump did something good, would you commend him for it on your podcast? Which I think was kind of a dig at me. He's basically saying that I'm biased or that I have Trump derangement syndrome or something. But also kind of a fair question because I haven't really praised Trump for pretty much anything. And my response to him was, yes, I would if he does something good. If he does something worthy of praise. And to me, he hasn't really done that yet. But I want to be clear. this policy is good. This policy is worthy of praise. Now, does Trump deserve the credit? I don't think so. I think he deserves maybe marginal credit. This wasn't his idea. This wasn't his agenda. I don't think his name should be plastered on the accounts for the reasons I just outlined. I think the credit is probably owed to Brad, maybe Michael Dell, who is helping to fund this. But the point still stands. These accounts are good. And the reason they're good is because they begin to address what we believe is the most pressing problem in America, and that is the unprecedented rise in inequality, the rift between what we call the earners versus the owners, what Karl Marx would call the proletariat versus the bourgeoisie. There are people who make their money through income, through labor, and then there are people who make their money through assets. And the American system, for whatever reason, is heavily rigged in favor of those who have assets, in favor of those who own things, the owning class. And this is why inequality has run rampant. And it's why the top 1% own about a third of the nation's wealth today. It leads to a loss of faith in the system, which eventually leads to some form of civil unrest, which historically leads to mass violence. And this isn't hyperbole. This is just history. Now, there are a few ways to fix this. One fix is we could just pay earners more. We could increase the minimum wage, for example. I would love that. But for whatever reason, our politics just isn't letting it happen. Another fix would be to tax owners more. I would also like that. But again, we've tried this many times and our politics doesn't really let it happen. Or we could simply make everyone an owner. We could give everyone a stake in this game that we call capitalism. And that is what this does. It recognizes the immense wealth creation after a one-time hit tied to its Apple Card deal. But mixed results weren't the only thing weighing down these earnings calls. Bank executives also had to contend with fresh political pressure after President Trump floated a proposal to cap credit card interest rates at 10%. On top of that, the sector is still reeling from the news about the DOJ's investigation into Federal Reserve Chair Jerome Powell. A lot here, a lot to unpack. We are speaking with Saul Martinez, head of US Financials Research at HSBC. Saul, thank you very much for joining us on Prof G Markets.
Thanks for having me.
So we want to get your reactions to this earnings. We've seen earnings from all the big banks here, and generally a sell-off. Any initial reactions?
Sure. No, I think the divergence between what were generally good results and outlooks and negative share reactions is telling of high expectations going into these results. So I characterize these results as good, not great. Now, in many respects, the results did really validate the bull case for banks. Net interest income's growing, loan growth's picking up. Capital markets revenues have been good. Credit quality is good. They're managing their costs effectively. The expectations from the banks are that profitability levels will go up. As you said, though, Ed, the stocks reacted negatively. JP Morgan's down 5% since they reported on yesterday, and Citi, Bank of America, Wells Fargo were all down 3 to 5%. Now, I think this, does reflect that the big banks have become darlings. They've outperformed considerably last year. They outperformed in 2024. Valuations are historically elevated. And I think there's some disappointment that results weren't even stronger. I think that is reflected in the guidance. The guidance that banks gave for 2026 is pretty much in line with where analysts are at, and likely doesn't trigger material upgrades from analysts. And if you overlay concerns about policy, which I expect we'll probably get into with cards, it shifted sentiment a little bit towards the bank. So I think it's a reflection of high expectations coming in, and the fact that the results were good, but they weren't great, and they're not necessarily going to lead analysts and investors to really ramp up their expectations, their baseline expectations for earnings and profitability going forward.
Just looking at some of these businesses, I mean, wealth management was a success at Citigroup, Bank of America, Wells Fargo. Some really impressive M&A numbers from Citigroup, up 84%, record deal making. I'm just thinking about what Wall Street is expecting or what they wanted in 2026 and what they didn't get in that guidance. Is there a story that you think that Wall Street was expecting, perhaps to do with investment banking revenue, perhaps to do with maybe the IPO market? What do you think they wanted that they didn't see?
I think it varies a little bit by bank. Some of the elements of the results were good. But again, like the expectation, what is in the market consensus is that capital markets revenues will be strong, wealth management will be strong. There is an expectation that we may be entering into a super cycle of investment banking activity. So I don't think folks are concerned about investment banking or capital markets related businesses. I think to a large degree, though, there's probably some disappointment with net interest income. So the traditional business of banks, lending, investing in securities. And part of the bull case, Ed, for banks is that we're now living in an environment where there's positive real rates across the curve. So a lot of the loans and investments in securities that banks made in a low interest rate environment are effectively repricing to a higher interest rate environment, and you're getting a positive benefit on asset yields that's driving net interest income. And I think the expectation was that banks would be even more positive on net interest income. JP Morgan gave some guidance in December about net interest income growing 30%. I think there was some hope that maybe they would increase that. I think the same story applies to Wells Fargo and Bank of America. So I think there was some hope that the traditional revenue driver of banks, net interest income, would actually be a little bit better than it actually was. But banks are basically saying that what analysts are expecting from that, for revenues is probably just about right. And I think there was some hope that they would raise guidance and that would, lead to higher earnings estimates going forward.
Yeah. Something that we should also bring up, certainly putting pressure on these stocks, Trump's proposal to put a 10% cap on interest rates on credit cards, which the banks do not like. Wells Fargo didn't like it. Citi didn't like it. JP Morgan CFO said everything is on the table to push back against this proposal. Can you tell us a little bit more about the proposal, how it will affect these companies, and if these companies should really be worried about it?
Yeah. Well, first of all, there's a lot to unpack here, and there's a lot of uncertainties. Right now it's a social media post as opposed to an actual proposal. And there's some questions about how it could even be implemented. I think most policy analysts, legal analysts would tell you it requires legislation. It's very hard to see legislation passing on this by January 20th. And it's hard to see legislation passing that would implement a cap of 10%. And an executive order on this would likely be met with legal action. So how this would be implemented is a very big question. It would have a devastating effect on the credit card business, though. A 10% interest rate cap on lending would make large swaths of the credit card business unprofitable. Broad swaths of the population would lose access to credit. Banks cannot make money, and credit card companies cannot make money given the loss rates on credit cards with a 10% interest rate. And there would be, so you would have to see a material change to the business models. Rewards would be cut. You would see more late fees. And, for JP Morgan and Citigroup, they would be affected, right? These are important business for them. It would have a material impact on earnings. But, especially for more pure play credit card companies who do have more exposure to riskier segments of the population, somebody like a Capital One, it would be, fairly devastating impact on their earnings and profitability. I think that if I make one additional point, though, because I think it ties into what we were talking about earlier about, the bull case for banks and what's in the expectations of the market. And, part of what has made the banks so attractive to investors is the view that they're primary beneficiaries of deregulation, that the direction of travel on policy is a good one. You're going to see, capital requirements cut, less stringent enforcement from regulators. And I think this was a reminder that policy can cut both ways. It's not a one-way track to, easy or more favorable regulation. And so this really threw cold water on an important part of the bank bull thesis. And I think it was a reminder that, there are risks. And this is something we did highlight in the report very recently as one of the key risks for 2026, especially as we head into the midterm election. And if you do get a situation where Democrats do really well in the midterm election, investors will be, we'll start to look to 2028. And it will be a reminder that maybe the very favorable regulatory policy that you've seen may not always be that way. But we got that reminder, I think, a little bit earlier than expected with the social media post last Friday.
100%. It is fascinating the extent to which Trump is influencing everything, including the markets and the businesses of these businesses. I mean, as you say, it's like it was all about deregulation. That was the idea, and that's what the market was getting excited about. Now it appears that maybe the banks aren't friends with the White House. Who knows? But the point being, this is what is moving the market. This is what decides the whole game. Just before we end here, I'd love to hear what we learned from the banks about Trump's investigation or the DOJ's investigation into Jerome Powell. We were discussing this earlier on in the week, and one of our guests said, it'll be very interesting to see what these titans of finance, what these leaders say about one of the most cataclysmic events that we've seen when it comes to the Federal Reserve in the past few years. What did we hear from the CEOs? Did they speak about it?
Yeah, I mean, it wasn't a topic of conversation that was, front and center. I think it did come up in the JP Morgan earnings call. I think the view of the banks, and I think Jamie did express this, was central bank independence is important, and it's important for pretty obvious reasons. So I think banks, bank CEOs will express that view. I think it is fair to say that, bank CEOs have to be, they represent the bank, and they have to be, pretty, they have to be, very judicious with what they say and how they say it. But in the current, political environment, but I think they did express the view, and they will express the view that, central bank independence is an important part, and having those safeguards, are important for the U.S. economy, and important for, the central bank's ability to carry out its mission of maintaining inflation under control. So, but I don't think we necessarily learned anything for, bank CEOs.
It's a pretty momentous week. I mean, I think all signs point to what we've been waiting a very, very long time for, which is who's going to succeed Bob Iger. And again, we thought we all knew that a few years ago with Bob Chapek, but that obviously didn't last very long. And so I think everyone sort of believes this time Bob really means that he actually is leaving. And so, all eyes are on this succession story.
Does that explain what happened with the share price? I mean, the stock's down 7% after a pretty great earnings call. I mean, overall is pretty good. What explains the movement in the stock right now?
I think the fear on earnings is that the March quarter, their fiscal Q2, because Disney's a fiscal September company, and so their fiscal Q2 is not great. There's a number of headwinds. The theme park attendance looks like it's going to be flat to down. They're signaling weakness in international travel to the U.S., and they're really putting the majority of the earnings growth they're expecting this year on the back half of the fiscal year. And I think, the minute you say to investors, the current outlook is not so good, but we'll pick it up or it'll improve later, that is generally a good signal to, I'm scared they're going to miss numbers, right? Yep. And then add on to it, Ed, the other piece of this is not just is Bob Iger leaving, but again, according to press reports, and this is unverified at the moment that we're recording, but the story goes is that Iger's also going to leave before his December 31st contract year end. So just imagine you're an investor, you're hearing earnings are very back half weighted, and Bob's leaving sooner than you expected. right? Like, and theme parks, which is the number one reason people own Disney. Like, sure, ESPN and Disney Plus, but if you look at like what people get excited about to own Disney now, given the size of the business, it's really about its theme park and cruises. So their experiences segment, as Disney calls it, that business facing sort of, headwinds from an attendance standpoint spooks people. And look, it may get better. But, attendance grew 1% this quarter, but they were comping against hurricanes. So organically, it was flat to down. Sounds like it's going to be flat to down in the U.S. in fiscal March Q2. And then the question is, can they actually accelerate that in the back half of the fiscal year? And I think you're seeing from investors today, they are nervous.
Yes. When we're just looking at the succession plan here, who's in the running? Who might it be next?
I mean, look, we've gone out in our top 20 predictions for the year and said it would be Josh D'Amaro, who is currently the head of the theme parks. I think, go back to what I just said a minute ago. The reason investors own this stock, like I can't say this enough times, they own it for theme parks. So to choose someone who is not the theme park person, I think at this point would be strange. Dana Walden is a great executive. She's had an incredible career. She came from Fox. When Disney bought Fox, she came over. She has an incredible resume in terms of what she's been able to achieve creating content over her career. But again, if you think about what Disney is all about, it's not really about television, which is Dana's forte, and it's really not about the TV business at all. Again, it's really, I really think about Disney as really two things right now. It's the creative engine on the film side that is driving theme parks and consumer products, Disney Plus. But it really, comes down to so much of this is the high profile movie content and the theme parks. And I think that's just not her focus. And so I'd be surprised if Disney went in that direction. I mean, look, Ed, there is always a wild card that either it's a dual CEO and or that it is somebody from the outside. But again, every single data point seems to point towards it being Josh. And then I think the really big question for your viewers and listeners is this an indication of Disney pivoting? Like, will there be a strategic pivot? Are they just keeping all of the assets they have today? Again, Josh comes from the theme park segment. He's not a TV guy. He's not an ESPN sports guy. Do they reconfigure the company? And our bet is that he's going to lead investors to believe that structural change, meaning separating the companies the way a Warner Brothers has been, is in process of separating, selling a piece to Netflix and spinning off their linear TV assets. That's obviously what Comcast just did with Versant. We think there's a lot of logic to Disney simplifying its corporate structure over the course of the next couple of years. It wasn't going to happen under Bob Iger. It could certainly happen in 27 under Josh.
And would that corporate restructuring involve moving the theme parks and experiences business to its own unit? Is that going to be sort of the Versant for Disney?
No, I think you would keep theme parks and studio and Disney Plus all in one unit. So you'd have the production of movie content, the production of TV content, the distribution on, Disney Plus. You would have, the Hulu business, but then you would take ESPN and ABC and all of those TV stations and ship it off into a separate entity. And so theme park, studio, and streaming all stay in one unit. And essentially what you would call, Ed, linear TV, which I know when we're talking about, a show that streams online, seems a little bit outdated at this point in time. You would take the very profitable. Remember, these are huge profit engines for Disney. I mean, I don't want to make light of the fact that ESPN and ABC are incredibly profitable businesses, but they're just not growth businesses in the way that the other assets are. And so I think you would capitalize them differently. Maybe they would look for their own M&A over the next few years. I mean, we continue to believe that Disney, if you got rid of TV and got rid of sports, could you lean into video gaming, interactive entertainment? Think about the Epic Games where they already have a joint venture with, or think about Roblox. Like, if you think about what your, viewers and listeners and what their kids are doing, it looks very different than watching linear TV in 2026. And so I think there's a lot of rationale for why a new Disney CEO would really rethink what the business should look like for the next decade.
100%. One that we haven't gotten your views on, it's been a while since we had you on the program, is the situation between Warner Brothers and Netflix.
I
And
haven't heard about that.
Paramount.
What's going on there?
Just can we get your updated perspective? I know that you're going down to DC for the hearing. What are your views on the Warner Brothers situation and how this is all going to shake out?
I mean, look, Netflix is currently the winning bidder, been selected by Warner Brothers. Paramount doesn't like it. Paramount is trying to run a hostile proxy battle to try to win over Warner Brothers shareholders. I think the challenge right now is, the approach that Paramount is taking is essentially, hey, we don't need to raise our bid anymore. We will just wait this out. We think we're going to get meaningful regulatory approval, and we think that will push Warner Brothers shareholders to pressure management to take and reconsider our bid. I think that's unlikely. I mean, just given where the Netflix bid is at $27.75 in cash, the stub, which is going to be spun off, probably has more value than what Paramount has talked about publicly. And so I think for shareholders, I think unless Paramount is willing to meaningfully raise its bid, it's in a tough spot. And I'll be honest, Ed, leverage, looking at the media business, especially a lot of TV assets, legacy media, linear TV, being levered, when you need to go through a dramatic investment cycle, like if you look at Paramount, I was out at UFC 2 weeks ago out in Vegas, like they need to go through, they just spent $1.1 billion on UFC. Those are the types of big, bold investments Paramount should be making. Like they're trying to change how you think about Paramount Plus. They want your viewers to have a reason to keep coming back to Paramount Plus. Great. But to make those types of investments, not having leverage or having low leverage is a real asset. And so levering up to 7 times or maybe more to buy WBD sounds a little crazy from our standpoint. And I actually wonder if we're past the point where if I'm really looking at this, like unless Larry Ellison's willing to put up a lot more cash of his own, but levering this company 7 times, at closing before you get all the synergies, levering it that high feels to me a bit dangerous. And I think if I were sitting there, if I was David Ellison, 42, 43 years old, having, 20, 30 years, 40 years in front of me, I think I would look at this and say, I can invest and build for the future. I don't need to over lever this to buy Warner Brothers. And so I actually think there's a scenario where they probably won't just walk away, Ed. Like I think they really don't want to walk away, but they probably should. And it'll be interesting tomorrow. There is certainly a view in DC that, oh my God, Netflix and Warner Brothers is too big and scary. But, on the flip side, like look at YouTube, right? Like the elephant in the room, as you know, and we've talked about on your show, YouTube is the monster, and it's the number one reason or the number one use of anything watched on the TV is YouTube. Like that's hard to fathom. And so the reality that Netflix buying Warner Brothers or Netflix buying HBO, it is effectively, it's like a 1-point increase to Netflix's market share on the TV. YouTube is still larger. I mean, YouTube's larger than Disney. If you take Disney Plus, ABC, ESPN, Hulu, ESPN Plus, YouTube is still meaningfully larger. And so like this idea that like Netflix can't buy HBO, I understand where it comes from, but I think it is not a well-educated view on what the actual competitive landscape and what your viewers are actually doing when they get home from work, the competitive choices of where they spend their time. I think if you really look at it honestly, there is tremendous competition, and there really shouldn't be a reason why that transaction is blocked.
100%. We'll be watching that throughout the day. A lot more we could discuss, and I'd love to do it another